Hello, beautiful future millionaires, and welcome back to another episode of turning 10k to 100k over time. So, last week I didn't buy anything as usual because I didn't spot much opportunity in the market. So, like I mentioned before, I'm not someone who's gonna be in the trying to be in the market rather than do not time the market. Because if you are looking for abnormal returns, you should do abnormal things that compared to what the rest of the markets are doing, which is just just DCAing and things like that. So I'm looking to time the market, and the reason why I'm looking to time the market is because next week there'll be the Fed fund rate announcement, which I think will create a lot of volatility, and I think this will give me the opportunity I want and the certainty that I need to start deploying my capital. So as shown on my portfolio here on Stock Penguins, I have not bought anything yet. Portfolio value is still at 10k SGD. So let's talk about what I plan to do next week, and I think before knowing what to do next week, right, it's very important to take into account what happened last week. So I think there were three main things that happened last week from the US stock market's perspective. So number one, earnings were great on paper, right? So Oracle, the stock, popped off on very strong guidance despite missing analyst targets. So the stock itself went up over 40% in a single session, which made Larry Ellison the richest man in the world, even richer than Elon Musk. And this is because of they have this ongoing contract with OpenAI, and the obligations that they have, right, is gonna be help set their growth driver on steroids for the next few years, which I think on projection and on paper is very good, right? But whether it is sustainable is another thing, right? So it's because anyways the company did indeed miss targets, so that's something to take account of. So there's this very big gap out on the stock chart, and which could fail, but nobody knows. But let's see what happens forward going ahead for future earning guidances, right? And number two, Adobe earnings were decent, right? They lifted guidance, and as you may know, Adobe is a company that has been hit with the narrative headwinds over the past few years, right? That because how AI may disrupt their products and services and things like that. But Adobe, despite that, is still growing very decently. And I think if they manage to prove themselves even further by launching new products and services and show that their user adoption and growth is still there, I think Adobe may be a very good company to consider adding to your portfolio, especially if you're gonna look for a turnaround large cap kind of stock, right? Number two, CPI and PPI, your inflation numbers. So PPI missed to the downside. So over there, producers' price index was cooler than expected, which technically is good for the economy, right? But this also shows that potentially there is already a recession going underway, because your producers' price index are what the goods that your companies buy to produce your retail end products, right? So if that side prices are cooling, it could mean that they're seeing some kind of slowdown, which is not good. And CPI was on target, and monthly figures were hotter than expected. But the thing is, for consumer inflation, right, regardless, the market shrugged this off and hit it higher. I think, and even then, they expected more rate cuts to come, with the Fed fund rates projection already looking at 3 rate cuts this year, right? But one thing to note that historically, cuts in the recession isn't the most bullish. So if you feel that next week, right, there is a rate cut, but the Fed says that maybe we're gonna hit the recession soon, this may not be a very bullish event, right? Because jobs are gonna be lost, things like that. Businesses are gonna start cutting, and I think overall for the economy isn't good. But that said, the economy is in the stock market, so there is a chance for anomaly. But anyways, we are in September, which is historically one of the most bearish months, and we are gonna probably cut into a recession. So expect volatility. Don't just buy regardless of what happens, right? Number three, some tariff threats. So Trump is asking the EU to place tariffs on China and India to pressure Russia, but I think this had zero impact on the markets, and nobody really care about it anymore. So basically what the market is looking at right now is a strong earnings projection. You see that earnings can still move stock prices heavily, even for mega large caps like Oracle. And number two, current economic health and the interest rate cuts path going forward. So this too is the most important thing in the current stock market climate that everybody should know of. We should always know have a gauge at least of which part of the market cycle that we are at, and what are the most important things that everybody is looking at. So that gives investors of all kinds certainty to deploy their capital. And another thing is, the markets are completely ignoring geopolitical events and tariffs at the moment until it matters again. So this usually means that it needs something fresh, another new catalyst to drive the emotions of the market participants. Tariffs, all that, some wars even have investors have sort of become immune to them and don't really care about it anymore. Yeah. So unless something new pops up, I don't expect much from current already existing geopolitical events, right? So let's take a quick look at the market climate at the moment. Fear and greed index, the market is trading at neutral. Trading at neutral when the stock market is at all-time high. So maybe take this with a pinch of salt, right? Yep. Momentum. Let's zoom in a little bit. Market momentum is in the greedy position. It's trading very far off the current 125 days moving average. So if anything bad happens, right, there's a chance that the markets may pull back. There's some sizable gap to pull back. Stock price breadth strong as usual. If you want to look more into the definitions of stock price strength and things like that, you could maybe just Google them. Yeah. Well, another thing is the seasonality that I mentioned earlier. February is typically the weakest month. So, but now, as of now, the returns for September is still very positive relative to historical. So maybe there might be something that happens, right? Which I feel could be the Fed fund rate announcement, right? Stock price breadth, still in a greedy position. Puts and call options. Most participants are very bullishly positioned, right? They're not covering up with their hedging their position with puts, so they're very exposed to the long side, right? VIX also very low, so there's not much volatility, which I feel that there could be a spike in the VIX next week with the Fed fund rate being the announcement, right? Yep. Looking at the let's zoom out a little bit more. Expectations next week. The markets are more or less priced in the cut for next week. That's probably not going to surprise anyone. But further down the line, towards the end of the year, market participants are very bullish. Sorry, not very bullish. They're very optimistic about 3 rate cuts by the end of the year. So if anything steers this right, probably there will be some volatility in the market, right? Yep. See, as your projections for rate cuts suddenly increase, more projected rate cuts, your treasury yield, your 10-year yield, treasury, all that start to crater, which happened. Yeah. Looking at the PE ratios of the market, Schiller PE is at a very high, quite high. I think it's expanded past the COVID highs now, where everybody was into stocks. Just a note that it has passed that now, and Schiller PE ratio. Price to sales also way past that now. PE ratio, still sizable room there, but I think the note that the S&P, I think, is very lifted by the Magnificent Seven stocks right now in terms of valuation. So this could be a little bit more skewed, right? So that's something to note. So when the general falls, everything else may fall even further with them, right? So now it's just generals carrying the pack. So if the generals start to fall, then this might crash. M2 money supply. So this doesn't change week over week, right? It's more of a month-over-month matrix. But just putting this out there again, that the money supply is still going up, and with the rate cuts coming, it's expected to go up. So with more liquidity in the market, it makes sense for the stock market indexes to continue going up. It will go up over time as there's more money, right? It makes sense. So looking into COT positioning. So I want to explain a little bit more about this, right? So what is COT positioning? And how you can use to read it. So COT report, typically it's a weekly report released by the Commodity Futures Trading Commission, right, that categorize market participants in the US futures market into several groups, including the commercial and the non-commercial traders. So commercial traders are like those people that actually produce goods and use futures and options to mitigate their risk against price fluctuation. So some examples of that could be your farmers, your producers that buys futures to hedge against the volatility of their produce. So for example, they could do something with their futures position to lock in a selling price for their product. So they could sell sell futures, and when these futures get called away, at least they'll have this fixed selling price that they can sell the goods at. And non-commercial traders are typically your large speculators like hedge funds and institutional investors, right? So I think this report is very good to use to gauge where sentiments are at now, especially when you see extremes in these positionings, right? So especially if your hedge funds are very, very long, your commercial who knows the market at the ground level is very, very short or something like that. So when this extreme starts to converge, right, that could usually mean a reversal in market positioning. So if you look at COT base, they will also guide you on how to use this. So let's zoom in closer. Extreme commercial signals. So commercials are the most knowledgeable participants on the futures market since they are producers, processors, or major hedgers of financial commodities. So they know the market on the ground, and their repositioning often leads to a major or interim market tops and bottoms, like I mentioned earlier. So yeah, they show the examples here with their commodities or even currency, right? But same thing can be used for your stock indices as well. So you can see here there are extreme positioning. Your commercials are very short, and your large speculators, which are your hedge funds, are very, very long. And you see when it starts to converge, right, usually means a signal of top in the market, right? Same case over here when there's like a sort of like a bottom in terms of local bottom in terms of positioning. That when it starts to converge and spread out again, you see the markets reverse and heads back up. So I think it's very useful to serve as a guide as to when markets could start to show a trend reversal, especially in the longer term situation. But looking at what happened, the positioning this week, right, you can see that the spider S&P 500, see there's still extreme positioning, and large speculators are not heavily long. So this is a little bit different from what the converse from what the other metrics are showing earlier. They are at extreme positioning, and if it closes, right, I feel that maybe that could be chance for market to hit higher. But if you look at the speculators, they're still not heavily long. So it feels a bit neutral for me at the moment. But if the gap starts to close, typically you could see like perhaps the market start to pull back slightly. As you can see, right, when your commercials start to start extending their shorts, you will see it pulling back. Same case here, now they're extremely long, but if they start to take our profits and maybe even go short, you can see the market start to pull back, right? Nasdaq, same situation, but I feel it was even more bearish since they already started to show like they're gonna extend their short positions, and your small speculators, right, typically your large retailers are still quite heavily long, but they reach quite a local top in this positioning. So there's a chance that it might pull back. But overall, I still feel a little mixed on this. So I don't think I would rely that heavily on the positioning for now. But looking at the if you really want to go buying stocks, right, I think the Russell 2000, the small growth cap companies, show the most potential because you see your commercial starting to go long again, right? And your small speculators are going long as well. So this typically means that there is a potential for it to continue climbing, right? Looking at the economic calendar for the upcoming week, well, if you look at the calendar, right, only one thing matters, which is on Thursday. You have your Fed fund rate decision, your economic projections and things like that. So with the market widely expecting a cut already, I think since the cut is more or less guaranteed, you shouldn't expect markets to be volatile based on this. But the conference statement and economic projections will be key. So it's the US economy every week. This will be a bearish event in my opinion, because like I mentioned earlier, cutting to recessions is typically bearish. But what's important is, well, we're not the Fed. We don't know what they're gonna say. We can only guess. But what is said here will likely influence the Fed's cutting path, which the market largely in general expects 3 cuts already. So if there is any uncertainty away from this, right, it could create your volatility and it could pull your markets back further, right? And earnings wise, not much next week. The company's reporting. If you want to, you can use toppenguins.com's earnings calendar tool, where you could see for next week which companies are reporting and how they reported, right? Did they beat their EPS estimates? Did they beat their revenue estimates, right? Oh, it's not really loading that well at the moment. But let's see for that FedEx on Thursday. Reporting 3 days from now. Yeah, but anyways, you could see your guidances, your historical beats and miss here, and your estimates, right? Next week, not much companies are reporting, like I mentioned. Pretty quiet week earnings wise. Aside on Thursday, potentially you could use FedEx, their earnings as a guidance of how the economy is performing, because these guys run the logistics of the US economy, right? Delivering our goods, things like that. And Lena is also reporting. So Warren Buffett added this stock to his portfolio recently. You could read to understand why he might have potentially do so. I have no idea what the company does, but just a call, random call, right? Yep. So quick takes of the market next week. I think before FOMC, you should expect muted movements. Only single company names could see volatility. Index as a whole should see like some very minor range trading, and depending on the FOMC's results and guidance, we could see volatility, and it could go both ways, right? If the Fed is very strict on the cutting path, and they are more dovish, which means they're going to cut more than expected, you can see the market start to boom up. But on the other hand, if they're very uncertain about cutting, and maybe they're going to adopt more of a look and see approach, then you could see maybe the volatility that the markets will pull back further, and then this will be a chance for you to get in if you are a deep buyer, right? So US indices, well, the SPY, I'm neutral and leaning towards bullishness after the FOMC event. Well, this is because despite what I said earlier about positioning, those are all proxy and a guidance. But I feel that since the federal, the Fed is getting pressured by Trump crazily, right? And there is like some form of recession in the US markets right now. So we could see like your Powell giving more of a dovish stance, and then the markets could go up. NQ, the Nasdaq, more bullish than the SPY. Well, the Dow feels neutral to me. But then Russell 2000, the small cap growth companies, this is where I'm the most bullish if we get the expected scenario one where Powell is more dovish. And there are some companies on my technical watch list. So let's head over the trading view. So number one, Root. Last week I called out Root as a potential company to invest in, right? Let's see the stock chart. Let me just search for Root. The company actually did break out of its range. So if you bought Root, congrats. And even like pull back nicely to the previous resistance and support for you to go back long. So I feel that there is still a chance for some volatility here for the stock to retest back to this support range, and for giving you the opportunity to go long. I think Root as a company is pretty decent as well, fundamentally. It's a fintech insurer. If you look at its growth metrics and things like that, they're growing very strongly. Valuation looks reasonable to me, and I think it's a good company to, besides technical trading it, you could look into its fundamentals and know for yourself that it's growing very strongly. The revenue is growing strongly, net income positive now, growing very strongly, free cash flow positive, growing strongly. Yeah, valuations wise still attractive. You could deep dive further into the company's fundamentals to find out more. But I think it's a company that I would look to be adding into my 10K portfolio, for growth. Number two on my list is Open Door. So Open Door is sort of like a meme stock, right? But that recently exploded in terms of its stock price. So last week, this huge jump, 50%, 60% gain in one day, is because of it's Spotify's COO being added to their company's management, and how the founders of companies are coming back to the business to run it, and all of their incentives, right, are tied to the stock price growth. So, for example, if the stock tripled and hit maybe $33, they'll get paid a lot of money, right? So this is a very good incentive for the stock price to continue to jump higher, and there is a lot of interest recently. We see volume is going up, but definitely I think this gap, there's a chance for it to be filled, and it might be a good, well, I wouldn't say a good time to go long and add this position in the portfolio. It's more like a gamble, right? Because this kind of stock is a lot of momentum trading. So never hold Open Door as a company unless you really like the stock. But I would enter it just for a technical trade. And number three, UNH and Lily. So looking at both companies, right? UNH is interesting case because I started to regain momentum again ever since Warren Buffett added shares to the company, and its valuation is still very good in my opinion. It's about to cover the gap over here. Let's see what happens when the stock price covers the gap, and it could even use this previous gap as a support. So if the market pulls back, I think this might be a good area for it to go long and add this to the portfolio, because looking at the runway, for it to go back to its previous prices, it's still quite a good 100% away, and this company is very solid. But you wouldn't expect it to just disappear from everyone's life, right? There's not much alternatives out there to replace United Healthcare. Am I right? As a business, if you look at its fundamentals as well, right? It's still growing very strong. Still not, I wouldn't say very strongly, but quarterly or quarter can still growing steadily, right? Net income still there, it's still growing. Free cash flow is still positive, but there's some headwinds recently. But at this valuation, I think if you are a contrarian guy looking to take advantage of betting against the overall market for stronger gains, UNH might be a decent company to do so. Lastly, would be a Lili. It's well, it went back to its previous trading range, right? And I think from a technical perspective, there is a chance for it to continue trading upwards. Not much gain, just a technical trade in my opinion. And I think even if you like the company, I think it's still a very decent hold. They are market leaders, right? And the healthcare space is ever expanding, and with the amount of resources and competitive modes that the company has, I believe that it's a very good long-term hold to add in your portfolio as well. Yeah. And lastly, Unity. So Unity is a company that creates that sells the Unity software that you could use to create your games and things like that. But they also expanded into using their software for other industries like healthcare and things like that. So the company, I think it's more of a trade in my opinion, right? There's a chance that it could retest here and then eventually break out this range and head back to the $58 range. So this is an opportunity for you to probably think about adding for a technical trade. If you look at the company's fundamentals, I don't think it's the best, but there is a lot of runway technical wise, right? It's trading under its past 5 year PE, average PE ratio, right? Its revenue is not growing that well. Net income is they're still making losses. Free cash flow is not that predictable, but this is purely a technical trade. So I think that's all for the next week. I think the companies that are most likely catch my attention will be the first three: Root, Open, and United Healthcare. And aside from that, I think the US market should probably be looking to create some volatility next week, especially after the announcement. But everyone's portfolio now rests on the hands of one man called Jerome Powell. Let's see what happens. Thanks.